Now I think we are all clear. Thanks so much for tuning in to Talking Point. I'm your host, Niraj Shah. Now, obviously, all of you would have guessed that Talking Point today would be centered around equity markets, right? And maybe other asset classes too, but largely equity markets, simply because of the nature of the beast and the whole of last week, the kind of volatility that we had. Very interestingly, on my phone, I have this note from Sandeep Tandon of Quant AMC, who sent it to me sometime last week about the note is titled Predictive Analytics, Quant Mutual Fund's Global Outlook, and various views on various points, with the headline being markets at an inflection, I'm guessing an inflection point. And we've had fair degree of volatility. So I thought it's best to get in Sandeep Tandon himself to talk about how does he see different asset classes and markets behaving over the course of the next few weeks, months. So both tactical as well as a slightly long-term view. Sandeep, great having you. Thanks for joining in. Hope all is safe.
Yes, absolutely fine.
So Sandeep, tell us. You wrote this note. Somewhat of the notes I understood very well. A couple of things I wanted some clarity on. Can we start off with how do you guys view this fear around yields, maybe some bit of inflation coming back, and the resultant impact that it can have on market multiples and thereby on the markets globally, and then subsequently the second order effect on India?
Okay, so I like to start much from a global perspective because we believe that problem is not in India. Okay, problem is macro, and which when we talk about that global market at inflection points, it's a very interesting data point which we are getting right now. If you look at from the like last 9 years journey, if you like last month's journey, actually market has rallied significantly. And if I have to look at the risk appetite from global market, which can be best judged from the Bitcoin also, because it's a most preferred asset class or young generation interest is there, very, very volatile. But for me, it's a very interesting data point from the behavior perspective. Okay. And the way it peaked out. So we got some signs of early peak, last Sunday. Okay. And it has given a very classic top closer to 5,700, 57,000 mark. So it's an indication that risk appetite globally has peaked out. Okay, that's the one inferences which we like to draw. And with the background is also that quant competency index or indicator for US market is a lifetime high. Okay, it was lifetime high on 16 February, and since then it started coming off a bit, which means that US market, if I have to call it from the vulnerability point of view, they are much more vulnerable at this stage. And we were expecting that if this is the data point which we are getting, which means the VIX can spike, bond yield can spike. We have been very vocal about that right from 2018 till 2023 is the phase of volatile market. So every asset class will remain volatile. The employed volatility of most of the important asset class will remain elevated, and this in the elevated macro environment or volatility environment, your traditional style and tools will not be very, very effective. So you should learn the art how to manage volatility in the current environment in your favor. Okay, so given the background of this volatile market, then we have been right from 2019, we have been showcasing that 2020 onwards commodities market will rally. Okay, and that will be the top of the dollar index from a larger perspective, and commodities market will rally and it will gather momentum in 2021 also. And we have been showcasing for last 2 years that inflation is coming back with a bang, and that's a sense which is getting built right now. Okay, we saw that 2020 commodities has given a massive move after April onwards. Okay, and this is a indication that something has changed globally. That's the reason people talk about growth cycle has peaked out. It's a time for value stock. If I have to conclude from the India perspective, which we have been talking about for a while, this is a year where you have to identify mid and large stocks, beaten down names, under owned, under research, okay, undercovered stocks, okay, because India risk appetite from a very near term perspective has definitely had made us some sort of trading top, but from a longer term perspective, we are still nowhere close what we have seen in US, okay, which means this mid and small stocks will give you better return as compared to large. But I'm also making a point, this is not going to be linear, entire move is not going to be linear. We have seen 9-10 months good moves, So there's a possibility next 3 to 5 months also that market gets into a consolidation and correcting phase. But stock specific action will continue. So one has to be very, very sector specific, stock specific in next 3 4 months perspective, because I see some amount of consolidation happening in this phase. And maybe
Wow.
the second half of 2021 will be even better than what we have seen in the first half.
Okay. And we will dwell on India in a bit, Sandeep. But since you look at global analytics and global pieces so well, let me just try and speak about a couple of things. There's this chart on the terminal, Bloomberg terminal, which showed, and I made use of this chart on Friday, about how the bond yields are now finally above the S&P 500 dividend yield. A lot of people believe that that's an incentive that equity holders have to have another option. 2020 was all about TINA. There is no alternative to equities. Has that come about? And does that lead, therefore, to some more outflows from equities? And could that have a collateral damage across EMs? What is your thought here?
So, see, when we talk about any spikes happening in the bond yield on non-immediate basis, like it has a psychological blow. Okay, so you will see impact happening, and which we have seen in last maybe in 2 weeks time or so, that impact is there. But my worry is still not, I think inflation and the bond yields up to certain extent is EPS accretive. Certain level of inflation and certain levels of interest rate moving is a good sign of a growth. So I think market, maybe after this initial reaction, market will realize this is a sign of growth, and we will not be too much worried about that. Once you start crossing certain thresholds, okay, which I don't believe it is happening on immediate basis, then the worry comes. And maybe for that we still have some time. It's not going to happen in a hurry. So you can see a small spike and then small consolidation. So gradually it has formed a base, but direction is up. Okay, but I don't see one should be too much worried at this stage about the bond yields or inflation. But longer term perspective, that is the big risk, definitely for global equity, less for Indian equities or less for Asia equities.
Okay, and I will talk about that point in detail with you. Why do you say that? But just a collateral move on commodities as well. I heard you mention that you had made this call that commodities would do well. We've already seen a very sharp spike in a bunch of industrial commodities. Farm commodities seem to be joining the party now. Do you reckon the move is still to last, or can it cool off a bit? Because I was just referring to the Chinese data. That came in over the weekend as well, Sandeep, or even last month. It was a bit soft. Do you think the commodity run could take a bit of a breather, or can this continue?
So let me answer in a different manner. In fact, in 2019, you are aware we wrote a book called Being Relevant, and where we have tried to cover how the market will be there for next 10 years perspective, next 30 years perspective. So we have talked about in that book and tried to explain that how 2020 till 2030, so maybe a decade sort of thing, belongs to agriculture. Okay, so we believe there is going to be a massive agriculture bull run, whatever we have not seen in our lifetime. That sort of bull run is unfolding. And 2019 it was knocking our doors, and we have seen 2020 onwards. We have seen the real moves. I think from the agriculture point of view, is still a beginning. Okay, we will see absurd price movements in the most of the agriculture prices globally in next 10 years. This is the background which I am talking, not from our analytics we do, because we also look at the earth analytics, how the climate change,
Yeah.
weather change, how the magnetic poles affect economy. Okay, and it's a very interesting data. How North Pole has shifted from Canada to Siberia now, how the magnetic fields affect the economy, how the crop yield has peaked out in US, particularly soya and corn is been, because so we have entered into a wet winter phase. Okay, whole world was worried about the global warming. It peaked out in 2018, and from 2018 and onwards, we have already entered into global wet environment, wet winter phase, which you call, which has a potential to last for another 40 years. Okay, and when this phase happens, this is based on a lot of historical and scientific and NASA data which we have pulled out and we are talking about. It indicates that yields have peaked out, your productivity will suffer because of extreme cold climate. That is what we have predicted, and we have seen impact happening in Texas very recently. Even I expect that Latin American countries and Canada also will also face something similar in next few years. So this all will lead to a massive move in the agriculture prices, not only from the demand perspective, it's the more from the supply side constraint which is coming up. Okay, and that is where and that is the big black swan event, if I were to call it. But that is not going to happen overnight. It's a longer term phenomena which is unfolding. But that is one background which we talked about, how agriculture bull run is coming. And if agriculture bull run is there to maintain, then it has its own cascading effect on the other commodities also. Now one can argue, even in US inflation basket, what is the percentage of food items? It's a very small, okay. But the multiplier effect is which I'm worried about, and market have just seen the trailer of this effect, which is just unfolded. Okay, we believe this is much larger super cycle which is playing out. In fact, in that book we have tried to showcase how inflation adjusted synthetic index which created, and we compared with Dow 100 years of history, and we talked about that in July 2019 it will be making a 100 years bottom. Okay, so
Okay.
that was the 100 years. So Dow has outperformed commodity index, synthetic commodity index, because global commodity index are skewed towards energy and precious metals. So we try to create a synthetic index with the equal weightage performance of all the commodities which are predominantly listed in US market from the COMEX and CME perspective, because we are
Right.
not looking at India data, and then do a inflation adjustment, because in the commodities inflation adjustment is very vital to understand that the real impact happening on the market. And that ratio was at 100 years low way back in July 2019, which we predicted, and exactly made a bottom around those level. And since that it has already rallied maybe 30-40%. So if you look at the larger picture, is still very constructive for agri commodities. So my bullishness is coming from agriculture commodities, not from commodities in general. And the larger theme is also the linking with dollar index, linking with the trust deficit which is there in the global currency
Sure.
market, how the bit can. So we are very constructive on Bitcoin or DLT framework from a longer term perspective, because it's a clear reflection when the confidence of dollar index will deteriorate. Our view is that we already have entered into a de-dollarization phase. Okay, and our big picture is
Sandeep,
next
Sandeep,
many
Sandeep,
years.
sorry,
Yeah,
that is too much data in one answer. So let me try and
yeah,
dissect
okay,
this for the ease of our people,
okay,
yeah, for even me to understand. So let's try and
okay,
dissect this one by
yeah,
one. You mentioned about an agri super cycle with an assumption that that might happen. I'm not going to go out and either challenge it or not challenge it, but
yeah.
let's assume that for a moment's sake that it has to happen. Is there is there a way in which the average Indian equity investor can play that? Should one, if one believes that yes, commodities could be in a bit of a super cycle, agri commodities could do well. Agri, I'm talking only about agri.
Yeah.
Can one play it? I mean, would you? Because I'll tell you why this is important, Sandeep. Because when you say this, and if people believe it, people will make a beeline for sugar stocks. They'll make for some other names, etc. Is that a sound way to do it, or you
No,
not?
no, because in India you don't get any perfect play to play any agri commodity, because agriculture prices up to certain extents are controlled out here. Okay, and it's a very politically sensitive segment. Okay, so you will never get the free pricing the way it happens in the US market. Okay, so our perspective is that it's very difficult to, maybe you can get quasi plays and maybe more of a sentiments play in these stocks, but real benefits will not get from. I don't think any stock is there which can give you that perspective, that direct play on agri out here in India.
Okay, so viewers, that's important to understand that even if you believe what Sandeep Tandon is talking about, an agri uptick, agri super cycle, there might not be direct ways to play this in India. Sandeep, part two of my question is something that we left unfinished in the answer. Agri will do what it does. What about industrial commodities? Because there are direct ways to play them. Some people have already played them really well. Um, is the cycle looking like topping out near term, or do you believe that there's still some time to go for the industrial commodities, industrial metals to do more?
So I think that is also, it will not be as dynamic as agri commodities will be. Okay, so if I have to look at the let's say talking about the metal cycles or the precious metal cycle, let's break precious metal, keep it separately for timing, because it's a different asset class altogether. When you're talking about the industrial metals or industrial commodities, so I think we remain very constructive from the background that we talked about in 2020, you remember, for the dollar top, and that's the way reversal started. Okay, now we are very at an interesting point from a global perspective, because dollar has around 89 onwards, 89.20, 89.30 onwards at the reverse. Okay, the whole world is very there's a general consensus of dollar collapse now, okay, which we were very early talking about it. Our view is slightly different from a near-term perspective. We believe that dollar has potential, or dollar index has potential to rebound from the lowest level, which is doing right now, and that's a risk for global commodities in the near-term perspective. When I talk about near-term perspective, maybe next few months perspective, it's very in a very high volatile environment. It's very difficult to visualize what can happen over from a longer term perspective, but from a near term perspective, with good amount of confidence, we can say dollar is showing signs of reversal, and that is not a great news for commodities in general from a very near term perspective. So we have played one easy round of commodities rally globally. Maybe they also will correct and consolidate, but if you ask me medium term and slightly longer term perspective, then outlook is still very constructive there also. It is not as constructive at AGRI, but it's still a constructive output.
Okay. Let's talk about the other part that you mentioned, that while US markets may be vulnerable, EMs and India might not be so.
Yeah.
There was this chart on the terminal again, Sandeep, which indicated that the MSCI Asia Pacific Index, for example, because of Friday's fall, fell below a key indicator as well. I mean, I'm not a technical student, but I just looked at the chart and it looked interesting. Again, there's still some time to go probably. Would you believe that these dips that are there are dips to be bought into? And part two of my question, just so that other people are more comfortable with what to do with theirs, can these dips get prolonged? Do you reckon that a healthy correction is still not happened, or do you reckon it's already happened?
So I think the way I look at the worry, as I said in the beginning, is not India. Okay, the worry
Yeah.
is developed market, and worry is US, where I have huge concern. And from the political perspective, dollar perspective, what is unfolding in US is something very different, which people have. When we talk about our complacency index, it could be lifetime high because we have 40 years of data, which is giving me a sense. Okay, so my vulnerability comes from the developed market, and being US being the mother of all exchanges, when something goes wrong in US market, it has its own impact in India too. Okay, so the background which we are looking at, one is the vulnerability in US. Second thing, the technical rebound or which can happen in the dollar index, which can affect the sentiments both in the commodities as well as the emerging market. Okay, but if I have to look at a much larger perspective, from the investment point of view, let's say next 3 years, next 5 years, next 10 years perspective, if I have to say, then I look at the much larger risk appetite data, how the Asian centric countries' risk appetite is significantly low as compared to developed market, particularly US. Okay. We always talk about, it's like how money flow happens. If I get into details of how money flow analytics work, so it basically money move from high risk to low risk environment. And that is my big call, seeing that money will shift from developed market, money will shift from the US market to Asia. And even if you get 10-15% of that money flow happening in Asia in next, let's say, in 3 years' time, that will be support Asian equities in a big way. I'm more bullish on Asia, including Japan, despite Japan being the developed market. So there's a clear shift which is happening towards Asia in a big way. So Asian countries or Asian emerging market is going to be beneficiary of that, and this is a larger thesis on the de-dollarization thesis also. So multiple data points showcase that Asia will do well in coming years. And India is also one of the biggest beneficiary of that. So we remain constructive from India. So India buy on dip strategy will clearly work from a medium to longer term perspective.
Yeah, but you're a fantastic tactical watcher, Sandeep. Do you reckon that tactically that dip, the buying opportunity on the dip is still some time away? Sure, you may nibble a here bit, you may be bottoms up, etc. But larger market, do you reckon there's still a potential of some more downside?
So I think that depends on the profiling of an investor. Somebody is looking at, from a next 3 years, 5 years, 10 years perspective as to investor look at, then definitely buy on dip is a strategy will remain. Okay, but if somebody is looking at purely from the trading point of view, 3 months perspective, I think it is going to be difficult, will be challenging environment for them, because in a very volatile environment, I don't think it is going to be linear one way up or linear one way down. When talking about correction, I don't expect it to be one way down happening for next 3-4 months. So it's not like the traders will go to make money. in a very choppy environment, it's going to be very, very difficult from their perspective. But what is very interesting from our point of view as a mutual fund player, okay, we we believe in dynamic way of managing money, so we are not too much concerned how the volatility will unfold and we will be affected with that. I think it's a very stock specific market, sector specific when we talk about money flow analysis, how we shift our portfolio from uh, what you call sector rotation or stock rotation. But what is very important is, I know, if I have to look at from my own perspective how we are managing this environment, okay, we have clearly shifted from mid-January onwards to low beta environment. Okay, so we have moved down our high beta bets in the portfolio. It's a relatively low beta portfolio running. When we are running our portfolio towards more towards mid and small, we're running more product in our portfolio towards beaten down sector or stock, which talked about the thesis. So we are very the vulnerability. Basically, we are trying to reduce the vulnerability which can happen because of US market, and that gives us comfort in the current environment. Okay, because our medium term and longer term outlook remain constructive. So how to navigate this near term volatility which can unfold, and that's the best way which we can play.
Hmm. So how are you? Okay, so Sandeep, I appreciate the point that as a mutual fund investor, you wouldn't want to really even bother about these short-term moves. So let's leave that out. When you're looking to construct your portfolios, dynamic as they may be, are there some themes that are looking ripe for a slightly longer-term perspective? Because I also heard you mention that this might be the year wherein the unloved, unheard, under-researched value names might come to the fore.
So this has been our thesis for nearly for a year now, okay, because when we spotted, what we defined from our behavior perspective, we have a, like two very basic thing, we have admire category, most admire category, beaten down and extremely neglected names. Okay. So we have seen in 2020, we have seen the number of stocks hitting the neglected territory, okay, and they hit some of the lifetime neglected areas. So it means the people have disinterest up to that extent. That's a typical, a classic case of a bottoming formation which happens in the market from the behavior perspective. And this is one of the reasons why I'm talking about when we're talking about that money will flow towards Asia, money will remain constructive, money flow remain constructive towards India also. That background, we think our predictive analytic tools are endorsing this is the time we have to identify. I'm just not saying that you identify junks in the market, because this is what typically happen, and we have seen a very euphoric move also in certain pockets, okay, where some of the beaten down names or um, bad quality names have also started hitting circuit. That's my point of worry which I'm taking. But if I ignore this noise, then there's still a space where you can identify these names, do your homework, and you will get opportunity, because they have reached that territory, where they cannot go down from these levels. Okay. So given the background for rising risk appetite, rising liquidity for Indian markets, then these are the names will come back.
So, Sandeep, without getting into specific names, what themes is it? Capital goods, infrastructure, real estate? I mean, where are these pockets wherein you're seeing value and the probability of these not going down too much?
So I think if I have to look at much larger basket, I think infrastructure stocks will qualify for that. Okay, which we talk about, whether it's a capex cycle related things or real estate. These are all parts of largely real infrastructure, which have not done for last many years, and I think it's a early stages for that recovery. Okay, but obviously price movement has been pretty decent in these names also. But if somebody has a longer term perspective, horizon which we are talking about, I think then buy on dips in this sector will give you good returns.
Okay. Final question on the conversation, Sandeep, and that is on gold and Bitcoin. The two are used interchangeably off late as a hedge against money printing across the world. I heard you mention that you are positive on Bitcoin, but India may ban um, Bitcoin itself, right? Holding any kind of cryptocurrency. So, what's in it for an average Indian investor?
So obviously we also don't can't play Bitcoin so because of restriction, but we like as a technology space, and as I said, this is a good proxy for me in terms of global de-dollarization thesis. So if I have to look at the global de-dollarization thesis, then this is the space which will play big role. Okay, but that is again from a longer term perspective and larger big picture perspective. This is going to play out, and it's not about just Bitcoin. I'm more constructive on the entire crypto space, entire DLT framework, which I have to talk about, and larger interest that is showing good. But if you look at the other asset class, like both from the precious metal point of view, okay, then the way I look at these markets, definitely precious metal, both gold and silver, we remain constructive from the medium term perspective. We have been bullish from 2019. We have talked about that part. Okay. And from 2019 onwards, we remain very constructive for the gold. And last year in August, September, we talked about how gold has peaked out from a very near term perspective. And that's the reason we have seen some amount of correction which has unfolded, but I think it could be a good opportunity. I expect one round of leg up can happen in gold from these level, whether it's become 1650 or closer to 1750 mark. Somewhere in near term, I think the reversal can come for the gold also from the current level. However, we are more constructive on the silver and platinum. Okay, we believe that silver has potential to outperform gold in 2021 and maybe in 2022 also. Okay, so silver has been affected a lot as compared to, and silver also has a industrial demand. So we remain more constructive from the silver from the current level as compared to precious metal. But from a medium term perspective, we believe the precious metal should be part of it.
Okay. Sandeep Tandon, take a moment to thank you for joining in today and giving us your thoughts. It was lovely talking to you on various facets. Appreciate your time.
Yeah, thanks a lot. Thanks, Niraj.
Yeah, the pleasure was ours. And viewers, thanks for tuning in to this edition of The Talking Point.